Here's some tips on getting your mortgage loan approved. So buying a house is already very stressful, and not being prepared heightens that anxiety that you're going to feel. So why put yourself and go through that? So let's learn to think like a lender and educate yourself on the best ways to get your mortgage loan approved. So one, know your credit score. Literally takes a few minutes to pull your own credit report and order your credit score, but surprisingly, some future home buyers never review their scores and credit history before submitting a home loan. Assuming that your scores are high enough to qualify, and many never consider the possibility of identity theft. However, a low credit score and credit fraud can stop a mortgage application dead in its tracks. So credit scores and credit activity have a major impact on mortgage approvals. So according to the Home Loan Center, a large percentage of lenders require a minimum credit score of 680. So if your score falls below that 680, lenders can deny your request for a conventional mortgage loan. In addition to higher credit score requirements, several missed payments, frequent lateness, and other derogatory credit information can stop mortgage approvals. So pay your bills on time, lower your monthly debts, and stay on top, of course, of your credit report. So cleaning up your credit history beforehand and fixing errors on your credit report are key to keeping up good credit scores. So two, save your cash. Requirements for getting a mortgage loan often change. So if you are considering applying for a home loan in the near future, be ready to cough up cash, or a lot of it possibly. So walking into a lender's office with zero cash is a quick way to get your home application rejected. But mortgage lenders they're very cautious these days. So whereas they once approved zero down mortgage loans, they now require a down payment. So the down payment minimums vary on various factors, such as the type of loan and the lender itself. So each lender establishes its own criteria for down payments, but average you'll need at least 3.5% down. So if you could aim for a higher down payment, if you have the means, of course, but 20% down payment not only knocks down your mortgage balance, it also alleviates PMI, or private mortgage insurance. So lenders attach this extra insurance to properties without the 20% equity, and paying the PMI increases the monthly mortgage payment, of course. So to get rid of PMI payments and enjoy a more lower affordable mortgage payment, you can do that. But however, down payments aren't the only expense you must worry about. So getting a mortgage also involves closing costs, home inspections, home appraisals, title searches, credit report fees, application fees, and other expenses as well. Closing costs are roughly 3 to 5% of the balance paid to your lender before you actually close on the deal. So 3, stay at your job. I know someone quit working 7 days before she and her husband were about to close on their mortgage loan. I have no idea why, and unfortunately it didn't turn out well for them. They didn't get approved. So they weren't able to close on the home, and they lost out on a great deal, and I think they lost out on their escrow deposit as well. So sticking with your employer while you're going through the process is crucial and critical. So any changes to your employment or income status can stop or greatly delay the mortgage process. So lenders approve your home loan based upon the information provided in your application. So taking a lower paying job or quitting your job to become self-employed throws a huge wrench in your plans, and lenders would then require to reevaluate your finances to see if you can still qualify for the loan. So 4, pay down debt and avoid new debt. So you don't need a zero balance on your credit cards to qualify for a mortgage loan. However, the less you owe creditors, the better. So your debts determine if you can get a mortgage, as well as how much you can acquire from that lender. So lenders evaluate your DTI, or debt to income ratio, before approving your mortgage. So if you have a high debt to income ratio because you're carrying a lot of credit card debt, car loans, other debt, the lender can turn you down your request on your mortgage. So this is because your entire monthly payments, including your mortgage, shouldn't exceed about 42-43% of your gross monthly income. However, paying down your consumer debt before completing an application lowers your debt to income ratio and can help you acquire a better mortgage rate. So, but even if you're approved for a mortgage with consumer debt, it's important to avoid new debt while you're going through the mortgage process. So lenders will often recheck your credit before the closing, and if your credit report reveals additional new debt, this can stop the mortgage closing because now you have higher debt to income ratio. So as a rule, avoid any major purchases until after you've closed on the mortgage loan. So this can include financing a new car, purchasing home appliances with your credit card, and co-signing for somebody else on a loan. So 5, very important. Always want to get pre-approved for a mortgage before looking at houses. So then you won't get emotionally or financially attached or responsible. So on one hand, you know what you can spend before bidding on properties. And on the other hand, you avoid falling in love with a house that you really can't afford. So pre-approval process is fairly simple. You submit your financial and personal information and wait for a response from a loan officer. Pre-approvals include everything from how much you can afford to the interest rate you'll pay on the loan, and the lender prints a pre-approval letter for you, and then the funds are available as soon as the seller accepts your bid. Though it's not always that simple, but it can be sometimes. So 6, know what you can afford. I know from personal experience that lenders do pre-approve applicants for more than they can afford. Don't let lenders or loan officers dictate how much you should spend on a mortgage loan. So lenders determine pre-approval amounts based upon your income and your credit, but they don't factor in how much money you spend on daycare, insurance, groceries, fuel. So rather than purchase a more expensive house because the lender says you can, be smart. Keep your housing expense within your means. So just final word is, if you don't meet the qualifications for a mortgage loan, don't get discouraged. Instead, let it be motivation to help you improve your credit and your finances and your assets. Many people have risen above credit problems, bankruptcy, foreclosures, repossession, specifically to purchase their first home or their second home. So just to be sure to implement a realistic plan and really stick to it. So thanks.